Okay, there's still people coming, but I think we'll get going. So this week, our guest is James Dupper from Edinburgh Investment Trust. So we'll be talking to him in a minute. But first, I've got a bit of news to run through. So three things. As usual, one popped up last minute this morning. So European opportunities first, then Gore Street Energy Storage, and then Chrysalis is the one that is the new one. European opportunities. We are actually, I can probably tell you this, in the process of writing a note on it, so you should get more information on it fairly soon, I hope. It's on a discount of about 10%, which is not too bad. You can see it's actually now been narrowing in a bit. But as you can see, the sort of NAV's been going sort of trending upwards, but not very aggressively. It's still a big fund, obviously, so turning it around is going to be quite important. It's got an AGM coming up in November, and there's going to be a continuation vote. I honestly don't think there's going to be a problem with that. We'll have to wait and see. We know that some discount type players have appeared on the register, but I don't think they're big enough to make a difference. And also, if you go back to the last time the continuation vote, that was just in the wake of Wirecard, and it still sailed through. So I think this is probably okay. And there is another one scheduled for 2026. So I think this is sort of coming quite regularly. But what the board has done is it's introduced a conditional tender offer. So that will kick in next time round. So if the fund doesn't beat the MSCI Europe over the next 3 years, so the 3 years ended 31st of May 2026, they will institute a tender at a 2% discount for up to 25% of the fund. In the meantime, they're going to carry on buying back shares as usual. So it's not a daft idea. Obviously, the fund's kind of synonymous with Alexander Darwell. He's been running it since the beginning. It's a growth-focused approach, which we know growth's been out of favour. But the returns since launch have been phenomenal. And I know it sort of has probably got sort of slightly poor reputation recently, but this is sort of like denting what is a very impressive long-term track record. Because of its size, the ongoing charges are quite acceptable. Doesn't use too much gearing. It's not a yield fund; it's a growth fund, but there is a small dividend there too. But the returns haven't been very good over the last 3, 4, 5 years, as you can see here. So there's the benchmark MSCI Europe, and you can see the NAV is well behind over 5 and over 3, a little bit over 1, so slightly improving. And if you look at it against its peer group over a year there, it is second last. But I think a lot of people harp on about Wirecard, and I understand why. It was a big knock to the fund. That was about 3 years ago now. But I think it's more of a problem with the fact that it's growth focused. As you can see, the returns are barely good for European growth. They're far, far worse. And that shift from growth to value has not helped. And it obviously did help people like Fidelity, though, which is why that's doing so much better. The other thing that I think may be an issue is that unlike the rest of the peer group, this is a pan-European fund, so including the UK. And he has about 30% of the UK. And as we know, the UK market is extremely unloved and extremely cheap. And so I think that might have been one of the things that's been holding it back. So basically, I think what we're looking at here is, I think it's going to get through the continuation vote this time. And then it's got 3 years to turn it around. If you can't do that in 3 years, then probably the tender is probably overdue. But I do have sort of some faith that he's going to turn this around now, having experienced the worst of the kind of shift away from growth. So that's that one. Gore Street Energy Storage, I wanted to mention this. This has really dived off a cliff recently, to the point where the discounts are looking ridiculous. And you can see it there. I mean, all of these discounts are daft, but sort of touching on 40%. And it's now got the highest yield in the sector. That was over 11 yesterday, day before. But still, it's 10.7. It's just crazy. And you look at the NAV returns, and they're amongst the best in the sector there. I mean, I know they drink at UK Windows ahead of it, but they're really not too bad. So there's some kind of disconnect going on here. Really, as far as I can work out, the problem is Gresham House Energy Storage. So they came out in September and said there was a hit to returns because power prices in the UK have not been as volatile as expected. And they gave some reasons for that to happen. They said that volatility is cyclical and will normalize. And it is true that you should get a bit more volatility over the winter in terms of the intraday power prices. We'll just have to wait and see whether that happens or not. One of the things that they pointed to, and this is something that we don't know how that's going to pan out, is that the national grid currently aren't using battery storage in the balancing mechanism as much as that was expected. There is a sort of presentation by National Grid, I think it's next week actually, to work to what their strategy is. So there may be some news around that. But a lot of the contracts that the National Grid were issuing that were the sort of mainstay of the revenues of these funds are now fairly saturated. So the returns of those are much lower. And there was a anticipation that they were going to be able to make more money now, switching to the arbitraging the intraday moves in prices. And that hasn't really happened. So that knocked confidence in the whole of the battery sector. It also knocked their NAV by about 5.7%. But the share price massively overreacted, and so did Gore Street and Harmonies. To the extent that Gore Street felt compelled to come out and say something about this, the managers actually stuck £1 million of their own money in on the day of their capital markets day on the 3rd of October. They highlighted the fact that their dividend cover is actually quite high, which, given that you've got the highest yield in the sector, is quite encouraging. And they also expect that to increase. In fact, I think it should increase quite a lot. And they were basically saying that maybe some people in the sector got a bit overexcited about what the long-term revenue opportunities were from some of these things, but they have had to unwind those. And so the implication is that we didn't get that excited to the same extent. But the big thing really is that whereas the other players are mainly in the UK now, I mean, I know that some of them are looking overseas, and Grid's got a project in America. Gore Street's always been far more diversified than that, and that does make a quite big difference. It's also not got a lot of debt. So this just illustrates, these are the revenue per hour that they're getting in the 4 different markets they're exposed to. And you can see the enormous gap. It's basically 10 times the amount of money that they're earning in Texas that they were in Great Britain. And as long as there's different sorts of things causing different sorts of volatility in different markets, then you should kind of get a blend of income that actually still looks quite attractive. And I think that's the part of the thinking in terms of their international diversification strategy. And it does seem to be working. The strong balance sheet thing, they have, as it says there, got a fair bit of cash, undrawn RCF. They've got a lot of capex in the going on. There's a lots of projects coming on. I'll show you in a second, but 85% of that is already funded, and they're going to be raising dollar debt to help fund their big California asset. So that is the pipeline. So end of June they had almost 300 megawatts. This has just come on stream. The Stony thing, 80. About another 80, but there's a long list of things that are going to come on over the course of the end of this year and into next year. And that's the big California thing that we're talking about the US dollar debt for. So it's going to end up with projects in place that are multiple of the current size of the portfolio. As these things come out of construction, there's almost always an NAV uplift. So you should see NAV progress through that. And obviously, as they get energized and start earning money, then this is what's driving up the dividend cover. So all sort of good ticks in the box, really. So yeah, Gore Street, I think actually doesn't look too bad. And now I'll just finish off with Chrysalis because they announced this thing this morning. They've got a continuation vote next year, and ahead of that, they've launched a shared open consultation this morning. One of the things that they've come up with is a sort of capital allocation strategy. It says they're going to keep a sort of cash reserve of about 50 million quid to cover the ongoing costs, to fund calls of capital for underlying portfolio, that sort of thing. To me, that seems quite a lot. And if it ends up being 50 million of dead money, that's going to be a drag on returns. But there we go. I think they're just trying to be prudent. Once they got 50 million perhaps sitting on the balance sheet, I think there's only about 30 million now. But once they got that from disposal, whatever, then money's going to be rolling off the portfolio. Then they're going to spend the next 100 million buying back shares. So they promised that they're going to do that. When we've reached that point, so I don't think it's going to be that soon, but we'll have to wait and see what happens with disposals. They keep saying they've got things they may be ready to sell almost that are really quite chunky. So one or two disposals could raise quite a lot of money. Anyway, once they get to the end of that 100 million buyback program, then they're going to distribute about 25% of net cash as in terms of buybacks or dividends, or well, more like not dividends, more like your sort of capital repayments. That all makes sense to me. I think that's going to help. If you actually see this starting to happen, then it's definitely going to help with the discount. They've also said exactly how the performance fee is going to work. I don't think there's an awful lot of changing from what we saw before. So the main thing is it's going to the managers rather than to Jupiter. A lot of it's kind of deferred to keep you sort of incentive to keep the NAV high. They're still going to keep the same high watermark, so we're still a way off where they will be earning performance fees anyway. It doesn't address the main problem with the performance fee, which was that it was unrealized gains. But I think given where we are in terms of the high watermark, it's not something that people are going to be worried about so much for a while. So there we go. I think that the strength of shareholder feeling is such that they're going to get some strong views back on this shareholder consultation, but I think they are doing the right sort of things to help address the discount and help improve sentiment towards the fund. So that's enough from me.